Good morning, everyone, and welcome to BP's first quarter 2021 results presentation. I'm here today with Bernard Looney, Chief Executive Officer, and Murray Auchincloss, Chief Financial Officer. Before we begin today, let me draw your attention to our cautionary statement. During today's presentation, we will make forward-looking statements that refer to our estimates, plans, and expectations. Actual results and outcomes could differ materially due to factors we note on this slide and in our UK and SEC filings. Please refer to our annual report, stock exchange announcement, and SEC filings for more details. These documents are available on our website. I'll now hand over to Bernard.
Thanks, Craig. Good morning and welcome, everyone. It's great to have you join us today. As ever, I hope everyone is staying safe and in what continues to be the most challenging of times. Today, we report our first quarter results, and it has been a strong quarter. We're making great progress right across the business, underpinned by our continued focus on what we call performing while transforming. And this starts with safety, our core value. As part of our strategy, we have harmonized our safety leadership principles, which define our safety culture and how we expect everyone to lead with care and with trust and speak up at its foundation. This has my personal oversight at our Group Operating Risk Committee, which I chair. We're seeing good progress. Staff in essential roles are beginning to return to the office and the field. Our maintenance activity levels are broadly back to pre-pandemic levels, and we have focused our assurance activities on our biggest risks during this time of change. And we continue to support our staff, our frontline workers, as well as those who continue to work remotely, remaining focused on their health and well-being during this unprecedented period. This supports our operational performance, which continues to be resilient and is an underpin to strong financial delivery. As we like to say, a safe business is a good business. In the first quarter, cash flow was strong, with an inflow of around $11 billion, including the accelerated disposal proceeds. As a result, net debt reduced by $5.6 billion, and we achieved our target of $35 billion during the quarter, around 1 year earlier than expected. We are commencing share buybacks during the second quarter, starting with the intent to offset the full-year dilution from employee share schemes. And Murray will talk more about this shortly. And at the same time, we continue to make disciplined progress executing on our strategy, including continuing the rollout of our single operating model to drive efficiency throughout our organization, strengthening our position in offshore wind here in the UK, and accelerating the development of our electrification agenda in Europe. So overall, we're in good shape, and I'm encouraged by the progress we are making in support of our proposition to deliver long-term shareholder value. I'll come back in a little while to share some more about how we are advancing our strategy, but let me first hand you over to Murray to take you through our results and provide more detail on our financial frame. Murray.
Thanks, Bernard. As usual, let me start with the environment. Oil price rebounded in the quarter, with Brent averaging $61, a 38% increase from the fourth quarter. We expect oil prices to remain firm as demand improves, driven by strong growth in the US and China, the ongoing vaccine rollout programs, and supported by continued supply intervention by OPEC+. The Henry Hub gas price averaged $3.50, up from $2.50 in the fourth quarter. The increase was due to Storm Uri in the middle of February, which resulted in very high gas demand, combined with a substantial drop in production, pushing prices to record levels. And refining margins improved. BP's RMM averaged $8.70, up from $5.90 in the previous quarter, supported by improved U.S. margins following Storm Uri disruptions and the higher cost of renewable fuel credits in the U.S. As demand improves, refinery utilization rates are expected to increase. Although, with net capacity additions of almost 1 million barrels per day in 2021, we expect industry refining margins to improve compared to 2020, but remain below pre-COVID levels. Looking to the second quarter of 2021, realized refining margins are expected to show a smaller improvement due to the slower recovery in diesel and jet demand. In addition, we expect a narrower North American heavy crude differential and a higher level of turnaround activity in our refining portfolio. Before I turn to results, let me remind you that this is the first quarter reporting under our new segmental structure. Further details on this and our new disclosure framework, including restated and resegmented data for 2019 and 2020, can be found on bp.com. I also want to draw your attention to a change in accounting presentation commencing this quarter. As previously disclosed, we have moved to net presentation of certain derivative contracts related to our trading business. While this is a significant change to revenue and costs, it has no impact on replacement cost profit or cash flow. Moving then to BP's underlying results. In the first quarter, we reported an underlying replacement cost profit of $2.6 billion compared to $0.8 billion a year ago and $0.1 billion in the fourth quarter of 2020. Compared to the fourth quarter, the result reflects an exceptional gas marketing and trading performance, notably from LNG and the impact of Storm Uri in the US. The result also reflects significantly higher oil prices and higher refining margins. And of course, my favorite figure on the slide, in the last 4 quarters, net debt has fallen from over $51 billion to around $33 billion in the first quarter. Finally, the first quarter dividend payable in the second quarter remains unchanged at 5.25 cents per ordinary share. Turning to cash flow in the balance sheet. Operating cash flow of $6.1 billion was underpinned by strong business performance and included a working capital build of $1.2 billion with $0.5 billion of severance payments. This build was largely offset by other timing differences. Cash flow was supported by the earlier than anticipated delivery of disposal proceeds, with $4.8 billion of disposal proceeds realized in the first quarter. We now expect proceeds for the year to reach $5 to $6 billion during the latter stages of 2021. Our target of $25 billion of disposal proceeds between the second half of 2020 and 2025 is now underpinned by agreed or completed transactions of around $14.7 billion, with approximately $10 billion of proceeds received. During the quarter, capital expenditure was $3.8 billion. Of this, $1.2 billion was one-off expenditures, including the final payment to Equinor related to the formation of our U.S. offshore wind joint venture, and the initial payment following our success in the UK offshore wind lease round. We continue to expect capital expenditure of around $13 billion during 2021, including inorganics. Reflecting this strong cash flow delivery, net debt fell by $5.6 billion during the quarter to $33.3 billion. Surplus cash flow of $1.7 billion was generated during the first quarter after reaching our $35 billion net debt target. Looking ahead to the second quarter, we continue to expect cash flow to be impacted by the $1.2 billion pre-tax annual Gulf of Mexico oil spill payment, further severance payments associated with our Reinvent program, and a smaller improvement in realized refining margins relative to the quarter-to-date rise in our RMM. As a result of these factors, we expect a cash flow deficit in the second quarter. Having reached $35 billion net debt target, we now progress to the second phase of our financial frame. We have a clear set of priorities for the uses of cash and a disciplined approach to capital allocation to support the delivery of our strategy. Our first priority is the resilient dividend, intended to remain fixed at 5.25 cents per ordinary share per quarter, subject to the board's discretion each quarter. Second, having reached $35 billion net debt, we now retire this target. We remain committed to maintaining a robust balance sheet with a strong investment-grade credit rating. Third, capital investment. We expect CapEx of $14 to $16 billion per year during the second phase, including inorganic spending. However, we continue to expect CapEx of around $13 billion, including inorganics, during 2021. And finally, share buybacks. We're introducing an intent going forward to offset dilution from vesting of awards under employee share schemes through buybacks. Surplus cash flow is now defined after the cost of buying back these shares. In addition, having reached our net debt target, we remain committed to allocating at least 60% of surplus cash to share buybacks, subject to maintaining a strong investment-grade credit rating. In considering the quantum of buybacks, The board will take account of the cumulative level of and outlook for surplus cash flow, with the intention to provide guidance on a quarter-forward basis while macro uncertainties remain. Now, let me explain how we plan to implement our distribution policy in 2021. First, our priority of a resilient dividend remains unchanged. Second, this quarter we intend to offset, through buybacks, the expected full-year dilution from the vesting of awards under employee share schemes, at a cost of around $500 million. Third, for 2021, the board is committed to using 60% of surplus cash flow for buybacks, subject to maintaining a strong investment-grade credit rating. We plan to allocate the remaining 40% to continue strengthening the balance sheet and support our credit rating. Fourth, given continued macro uncertainty and the expected second quarter cash outflow, we will provide an update on our third quarter buyback plans at the time of the second quarter results, taking into account the surplus cash in the first half of the year, as well as the outlook for surplus cash. In the second half of the year, we expect to generate surplus cash above an oil price of around $45 per barrel, with an RMM of around 13 per barrel and Henry Hub of 3. Looking ahead through 2025, we believe our approach to dividend and buybacks provides for attractive total distributions per share with upside to higher prices. Thanks for listening, and now let me hand back to Bernard.
Great. Thanks, Murray. As I mentioned earlier, in addition to driving performance of the business, we've been making disciplined progress in advancing our strategy. I thought it might be helpful to share some examples with you. Let me start with some highlights from the quarter, and then I'll look at 3 examples in a bit more depth, and we'll then have time to take your questions. This slide shows the progress we have made so far this year, from taking delivery of the Argus platform in Texas after a 16,000-mile journey across the world, to planning the largest blue hydrogen project in the UK. I won't call out everything in detail, but I do want to emphasize some key points. Starting with the cash engine, resilient and focused hydrocarbons. 2 new major projects are now online, further underpinning our production target of 900,000 barrels equivalent a day by the end of this year. First, the Raven project in Egypt. This is a significant milestone and is expected to continue to ramp up throughout this year to deliver around 140,000 barrels a day oil equivalent of high-margin production capacity. Second, the KGD6 satellite cluster in India, the second of 3 projects we are developing with our partner, Reliance. At peak, the projects are expected to produce around 65,000 barrels oil equivalent a day net, enough to meet around 15% of India's gas demand. And in the Gulf of Mexico, the Mad Dog Phase 2 Argus platform arrived safely in Texas. Once online, the project is expected to deliver around 65,000 barrels a day equivalent to BP, supporting high-margin growth through 2025. In addition, we recently announced an oil discovery at the Puma West prospect near Mad Dog, further highlighting the strength of our business in the region. Turning to low-carbon electricity and energy. During the first quarter, we increased our hopper of offshore wind and solar opportunities by 15 gigawatts, while continuing to high-grade, turning down projects that did not meet our strategic or returns requirements. Net to BP, our hopper now stands at 35 gigawatts of opportunities that could be progressed into our renewable pipeline. During the quarter, we grew our pipeline of identified projects by 3 gigawatts, including 1.4 gigawatts of solar pipeline and preferred bidder status on 1.5 gigawatts awarded in the UK offshore wind lease round 4. I will come back to talk about this in more detail shortly. Our pipeline now stands at 13.8 gigawatts, firmly underpinning our 2025 target of 20 gigawatts net to BP, developed to final investment decision. And we also announced our plans to develop the UK's largest blue hydrogen facility, targeting 1 gigawatt of production by 2030. Integrated with the BP-operated Net Zero Teesside and Northern Endurance Partnership, this project marks an important step in BP's hydrogen business and would significantly contribute to the UK's 10-point plan. We have also continued to extend our partnerships with countries, cities, and industries, recently signing a memorandum of understanding with Infosys in India. Together, we will explore development of a digitally enabled energy-as-a-service offer at Infosys campuses, which could later be scaled to industrial parks and cities. And finally, we continue to advance our convenience and mobility strategy. Compared to the same period a year ago, we have added around 300 strategic convenience sites and increased our convenience gross margin by over 10%. Electrification is core to our next-gen mobility strategy, and we have announced plans to work with a number of OEMs such as BMW, Daimler, and Volkswagen Group to increase the scale, reach, and utilization of our EV network. Let me now explain how these announcements come together to underpin delivery of our EV agenda. Our EV customers want fast, convenient, reliable, and seamless charging integrated with leading convenience offers and services. To deliver this, our strategy is to provide the fastest, most convenient and reliable network of chargers situated in advantaged locations, have leading-edge digital technology, and drive higher EV adoption and utilization of our network. By 2030, we aim to have more than 70,000 BP-operated EV charging points and expect to have grown margin share from convenience and electrification to around 50%. So how are we progressing? We already have an established presence in the UK, Germany, and China, and we need to continue to rapidly scale up to meet growing customer demand. The announcements we have made this quarter clearly demonstrate that we are in action and leveraging our integrated model, particularly in Europe. First, our announced investment in digital charging solutions alongside Daimler and BMW. Through apps and in-car dashboards, DCS connects millions of EV drivers to a European network of nearly 230,000 charging points. Through our investment, BP's network of 8,700 charging points will be integrated with those of DCS. We expect this to drive up our utilization rates and increase footfall at our convenience stores. Second, in Germany, we are accelerating deployment of ultra-fast charging points at our Aral retail sites. We plan 500 ultra-fast charging points at our sites by the end of this year, and we expect to capture significant integration value with our convenience offer. Third, we have recently signed a memorandum of understanding with Volkswagen Group to explore the expansion of ultra-fast EV charging networks and the integration of our own charging networks into their vehicles across Europe. This has the potential to add a further 8,000 charging points by 2025. And finally, BP Pulse has announced the rollout of EV-only ultra-fast charging hubs in the UK, with the first due within a year. As we build scale, we expect to create significant demand for electrons and the opportunity for integration synergies with our renewable power business. For example, we plan to grow the BP Pulse network to 16,000 charging points by 2030, creating around 1 terawatt hour of annual demand. And by 2040, even in our low case, electron demand from our EV charging network in the UK could underpin over half of our net output from the recent UK Round 4 offshore wind lease awards, creating uptake optionality and further supporting our aim to be the most efficient price setter in EV charging. In summary, we know what our customers want, and we have an integrated strategy designed to meet their needs. The progress we have made this quarter is a clear demonstration of that. We are expanding our network to help drive the adoption of EVs and provide customers with a great experience, and we are leveraging the power of partnerships to enable better and faster utilization of our network. And we are moving at pace to keep up with this fast evolving market. We believe this strategy will underpin our aim in convenience and mobility to nearly double EBITDA by 2030 from 5 billion in 2019 and deliver 15 to 20% returns. Turning to offshore wind, in the 9 months since launching our strategy, we've made good progress, growing our offshore wind pipeline to 3.7 gigawatts net to BP and materially growing our hopper. Some have asked us about our strategy and why we believe we can deliver attractive returns. To explain, I'm going to talk about the UK, where we have been selected as the preferred bidder for 2 leases in the Irish Sea, along with our partner EnBW. We believe this is an advantage project which compares favourably to other leases offered in Round 4. It benefits from 4 key attributes. 1. Advantaged wind resources. 2. A favourable location. Optimal connection to infrastructure will enable lower connection costs and stronger operating reliability. 3. Less complex consenting and grid connection issues, which should result in a shorter development cycle time. And 4. Adjacent leases offer opportunities for synergies in execution and operations. We expect this project to meet our investment threshold of 8 to 10% returns. Our integrated model gives us confidence that we will deliver value from this project. A few examples. The development phase will benefit from our centralized projects organization, bringing our offshore hydrocarbon expertise to offshore wind. We plan to leverage our established offshore supply chain using our scale and experience to manage costs and supplier relationships, for example, with turbine manufacturers. And decades of offshore project management experience will help us plan and execute the projects efficiently. In the operational phase, we will use technical skills established during 10 years of onshore wind operations, including our digital know-how. Finally, in the offtake phase, our world-class trading organization will utilize our expertise in power markets to manage risk and market access optionality, likely to include CFD mechanisms. We are building a portfolio of customer demand contracts with companies like Amazon and supply agreements with customers such as Pure Planet and Utilita. And in our own business, we are creating demand pools which will allow us to establish integrated value chains. Through our rapid expansion in EV charging that I described earlier, the potential electrification of our offshore oil and gas facilities, and in the longer term, the potential for green hydrogen underpinned by the optionality of a 60-year offshore wind lease term. In summary, our integrated model gives us confidence in achieving 8 to 10% returns and accessing multiple sources of upside. Turning to our single operating model, the most significant change to come from our new organization structure. We see a huge prize in running operations across the whole group in one place. This includes oil wells, refineries, and offshore wind farms. We expect this to significantly contribute to $1.5 billion of annual cost savings from our hydrocarbon business by 2023, part of our $3 to $4 billion Reinvent BP target, drive improved reliability and availability, and create integration value as we leverage our capabilities into low-carbon energy. So how do we plan to achieve this? First, through a centralized and standardized approach to development and operations. While we had centralized teams in our upstream oil and gas business, our operating model is now being extended to all of our businesses, including refineries and low carbon. Through our newly created BP Solutions team, we are sharing best practices across our global portfolio, deploying our best experts to work on our biggest opportunities in order to add value. Here are 2 great examples from the last 3 months. We've taken furnace experts from our European refineries to support the safe startup of our Raven major project. And we've deployed compressor expertise from the Whiting refinery to a construction yard in Mexico to support the commissioning plan for the Cassia compression major project. And looking to our low-carbon business, in addition to leveraging our established supply chain and project management experience in offshore wind, hydrogen, CCUS, and biofuels are other areas where our existing capabilities and integrated single operating model can create a competitive advantage. Second, we are in action to change the way we work. Following a successful pilot in Azerbaijan, we are now rapidly scaling the use of business agility techniques across oil and gas production and our refineries. By the end of this year, we expect to have over 14,000 people working in agile teams across BP. Third, we continue to invest in digital tools as a key enabler for performance delivery and risk reduction. We will manage production from sand-face to export in an integrated, fully digitized workflow, assisted by our Apex and Vertex products, as well as the use of digital twins across our portfolio. We're also deploying a proprietary tool called Operator Workbench. This equips field teams with mobile technology and digitized workflows to improve collaboration, safety, and efficiency. 2 examples. In Oman, its use has freed up thousands of hours to allow operators to focus on priority work and has reduced the amount of driving and risk of human error by signing off on work at site. On our Atlantis platform, we're using it in our operator rounds, and it has enabled savings of $1.5 million per annum on water treatment alone. We believe the use of this integrated approach will allow us to leverage our deep skills and knowledge across all operations and will be at the heart of our transformation to an integrated energy company. So in summary, those are just 3 examples of our strategy in action, and they illustrate the momentum we see in our business. I hope they help you understand what an IEC looks like and why we believe that the energy transition represents such a great business opportunity for BP. As we transform, we will continue to share our progress with you. And we welcome your feedback on how we can provide greater insight into our strategy. In the 9 months since launching this strategy, we have achieved a lot. We've reset BP and entered 2021 in a strong position to compete. We are leaner, flatter, nimbler, and 100% focused on execution. We've delivered a strong set of results for the first quarter. Our financial frame is robust. We are committed to distributions and are commencing share buybacks in the second quarter. As you can see, we are progressing our strategic agenda with discipline and a focus on value. This is what we mean by performing while transforming and how it supports the delivery of long-term value for our shareholders. We're excited about what's to come and look forward to updating you more as the year goes on. Thank you for your time today, and let's now turn to your questions.